Good morning, good morning, good morning. Today is Tuesday, February the 17th, 2026. The markets will be open in about 2 hours from now. It's 7:39 a.m. The markets open up at 9:30 a.m. Eastern Standard Time. So the markets will be open in about 2 hours. However, the futures market is still moving. But the reason why I'm recording the video this early before the equities market opens up is because I'm looking at my /ES, which is the S&P 500 futures. Now, notice when I had put this trade on originally with 3 contracts, I had put it at the 10 delta, which means it gave me a 90% chance of the futures expiring out of the money or not reaching the strike price on the put side. However, it's now at a 19 delta, which means there is now a 21% chance. I mean, not 21, I'm sorry. Or there's an 81% chance that it's going to expire out of the money instead of a 90% chance. So um, remember, the whole point of trading is not to just make money, it's to keep money or to become a profitable trader. So think of it this way. In sports, we have an analogy called that is constantly being phrased, and it's in all of teams, especially all of team sports, but it's probably the same in individual sports. Offense sells tickets, defense wins championships. Okay, so in trading, I like to use an analogy. Offense, which means putting on the trade, helps you make money. Defense helps you keep money. So I'd like to use that particular phrase. And like take a sport like hockey. The goal is to put the puck in your opponent's net and keep the puck out of your net. In football, the goal is to score touchdowns and field goals, get points, but it's to keep your opponents from getting points. And right now, the market is trying to get some points from me because see now they moved up to a 20%. So that means it's an 80% chance now that this futures will hit this strike price. So, and this is where I want to credit the Dorian Trader because the one thing that they taught me, and I could have learned this from other courses as well, but the course, which was the latest course that I took, which was the Dorian way, and I will leave a link in the description, is how to defend a trade or how to adjust a trade because it's just like an airline pilot. He prepares for every contingency that could happen, any kind of emergency. He prepares for that. That's why they use simulators. That's excuse me. You should not be doing these type of trades without first paper trading. That's where I made the mistake was learning on the fly. Don't make the same mistake I made was trying to learn this using real dollars. You should paper trade this to see how this stuff works before you do any of these type of trades that I'm doing. Because this is not a financial recommendation. These are just things that I'm doing. And so it's not for you to, I'm not telling you to go out and do these things, but when you put on a trade, you have to know how to defend the trade or to adjust when things go wrong. Because, see, it's nice when you're flying and everything is sunny and good and all clear and there's no problems. However, when things start to become a problem, you don't wait until the plane's about to crash to take evasive action. A good pilot, when he sees a problem that might be getting ready to occur, he starts taking evasive action before it becomes a major problem. Well, in this particular case, it went from a 10 delta to a 20 delta. So that means this is closer to getting in the money. Even though I still got a chance to win on this trade, what I'm going to do is to adjust this trade to protect myself. So what I'm going to do is buy back this spread, okay? And what I'm going to do is to move it down to around a 10 delta, actually even a 9 delta, 15, and do another 20 point. So what I'm going to do is give up about $200. So I'm going to pay back about $200 on this spread. But what I'm doing is going into further safety. So what I'm going to do is give up $200. Hold on, I'm thinking. Yeah, I'm going to give up $200 and move to further safety. And the same expiration, which is today. I'm going to wait for this position to clear. But now you will say, "What you mean? Why would you give up $200 on you?" Well, the whole point is to get that money back, and the way I'm going to get it back is on the call side. So I'm going to move up this call, and the way I'm going to get this back is move this up to about an 8 delta. So that's a buck 50. So no, that's not 200. So now I'm going to move this up to an 11 delta. So that gives me that 225. So this makes back up the loss that I'm taking on the put side by rolling it down. Actually, let me adjust this, edit. I'm gonna go a little higher. There we go, 252. So this brings back, and I'm gonna see if this clears. But what this does is it just simply rebalances it and keeps my position as safe as possible. So I'm just having a little dance, as they say. And the reason is because, see, what I learned in the Dorian way, what they taught me was that 0 to 15 is the green zone. So as long as the delta is between 0 and 15, excuse me, there's no need to make an adjustment. 16 to 30 is the yellow zone. And in 16 to 30, I could make an adjustment. I don't necessarily have to make an adjustment. But the higher it gets up to that towards that 30, you might want to make an adjustment. And then 31 and up is the red zone. And when you get into the 31 and up on the deltas, and we're talking the deltas, the probability of getting in the money or getting to touch, you want to make an adjustment as long as the trade, still has some time remaining. So that's why I'm making this adjustment, and let's see if it clears. So that's how you can still be profitable on these spreads, even when you make the adjustments, how you can be profitable on these spreads. So if it should clear, I will come back on later on and let you know if it fails. I will talk to you later. Bye bye. Good morning. Good morning. Good morning. It's now 9:35 a.m. on Tuesday, February the 17th. The market is now open, but I'm talking about the equities market as well as the futures. So what I'm going to do is I got some positions on that I want to make some adjustments on. Oh, by the way, uh, my futures SPX futures trade it finally filled, so I was able to make the adjustment and went through. However, I have some other positions that is in a little danger. So let me just simply, I'm not gonna do anything right now with DraftKings. You know what? Let me go down the list. Applied materials. Let me see, 34, 34, 16. What I'm going to see if I can do is roll this position down, give myself more room. So I'm going to spend about 78 cents, and I'm going to roll this position up. I have what is called a strangle, and which is a naked call. Let's see. That's a debit. I want to move this up. I want to get at least a credit. Let's move this down. This increases our buying power. Let's see. So I moved the put down to 32, and I moved my call up to 35 and a half. So I'm good there. So I gave myself more room. Bidix, I own 100 shares of this, so I'm not going to do anything right now. I might go ahead and see about a covered call. Let's see what we have here. Let's do 10 days out. Let's see. Yeah, we'll do 10 days out. We'll do the 17, collect at least 70, 26 cents. So I just collected $26 or 20. Let me see. Let me see. Da, 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 da. Hmm. Collected 43 cents. So that's good, or $43. So that lowers my cost basis by $43, or 43 cents, should I say? It lowers my cost basis for Bidix, Costco. I guess I can go and close this one out. Let me see where we're at. You know what I'm going to do? I'm going to roll this up, see if I can get more for 3 days. Roll this up to about a 10. Let me see how many strikes difference. I'm 10 points wide. Okay. Why is my mouse acting funny? Oh, this is ridiculous. I ain't got time for this. My computer. Oh boy. I don't need this right now. Okay. Oh, my mouse is acting funny on my computer. And this is not a good time to be doing this. Oh, what's wrong with my mouse? Okay. I'm gonna have to. Okay. Now it finally fixed that. This is 10 points wide. So if I do this, 80, 70, I collect another $32 of credit. Let's see if that fills. I'm just going down my positions. I don't need right now cars. Let me look at Google. Let's see where we're at. These expire on Friday, by the way. This is at 23. So what I'm going to do is roll this down. This is 5 points wide. So I'm going to go here, in here. So I'm going to pay $49, $54. And then what I'm going to do is sell a call spread or move this call spread up. Move this here and here. So I move that up. So I make up the loss that I made on the put, well, by moving down the puts. Harley Davidson. Okay, we trade on this. This 2 points wide. Ugh, these premiums are lousy. So you know what? I might not do anything. No, I'm not going to touch this one then. Let me cancel this. I'm going to wait on Harley Davidson because they got lousy premium. So I bid. These expire in August, so I have time. But in the meantime, I'm going to do a 3 day, which is a Friday expiration. I'm going to reduce my cost basis by 19. You know what? No, I'm not going to touch IBIT right now. I'm not going to touch IBIT. Intel, let's see. I got 100 shares of Intel. 3 days expiration. So it's Friday expiration. Let's do the 48.50 because I own 100 shares. So I collect another $44, $43. So I'm doing what they call covered calls, by the way. That's what that is. JEPQ, let's see. The premiums are lousy on this. No, I'm not going to collect nothing. A dollar, yeah. I'm going to pay more in fees than I will for what I will collect on that JEPQ, so I'll hold on to that. PayPal, my call is in the money. This is a oh, this is the long call. Oh, okay, so no, I don't want to touch this one. Yeah, I want this to go up. So yeah, sorry, this is what you call a call debit spread or bull call spread. Yeah. So this is profitable as long as it goes if it keeps going up. So that's good. That's what I want. SCHD, let's see. On 100 shares, let's see what I can get for a 3 day. Okay. 10 day. What I'm going to do, let's see, if I buy a put here, pay about 40 cents. But I'm going to sell up. And I'm also going to buy, let me sell a put here as well. Let's see if it will give it to me. Get a 48-cent credit because I own 100 shares of the stock. So this will reduce my have no bid prices. Shoot. I'm going to take a shot on it. Let's see. It probably won't fail though because got TQQ, or should I say TQQQ? So right now it's at a 40 delta, which is in the red zone. So what I'm going to do, and I'm 3 points wide on this. So I'm going to roll this out to around a, let's see. I'll roll this down to a 45 and a 42. I'll pay about 27 cents. So I moved it a little further out of danger, even though now it's at a 27 delta. And then what I'll do to make up that 27 cents is on the call side, I collect 67 cents. So this is how I'm just adjusting my spread. So whatever I lost on the downs, I mean, by moving the spread, I adjusted the put side. So I ended up paying 27 cents to adjust, get it further out of away from danger. but then now I've collected more to on the call side to make up for the loss that I did on the put side. So that's just basically doing a little dance, as we call it. Tesla. Okay. Ooh. Now this is in the money. So what I'm going to do is roll this out, put side. So I'm going to pay $6. No. And we're going to roll this out to about, so it's 5. This is 15. 15. So pay about $4.09. $400 I'm going to have to pay to roll this out. To roll this down, let's see. Okay, just four nine. This should clear soon. Let's see. Let's replace order. A debit. 420. Okay, so I moved that a little further out, and so what I'm going to do to make up for that, let me see, 95 is 15 points wide, so I'm going to do 15 points. This only gives me 295. So what I'm going to do, let's see, I'm going to move the strikes up because I want to make up what I paid. So this should work. This is a little dance. So that makes up for what I'm paying to rule out to move out the puts. I want to collect on the call side, so this way I'm not losing no money when I'm doing these trades. Actually, let me adjust this position. Let me do something. Actually, I'm going to adjust this position because I don't want, let me see, 25. Okay, so this is a little dance that I did. I just went and adjusted the position a little bit. So I'm good. Right now the markets is down, it looks like. Okay. Let's look at the S&P 500, SPX. Markets is down $46. All right. Yeah, I'm not right now. I'm not worrying about my P&L because see, again, with the market down, everything's fluctuating. But as soon as it goes back up, all these positions become very profitable. So I'm not really worrying about that. But I'm just waiting on and this gold and this gold trade because this expires today. Let me see what delta these are at. 18. So what I'm going to do, this is in the yellow zone. So what I'm going to do is kind of move this down to give myself more room towards the 10. Pay about 80 cents or $80. Even though it's not in danger, but I just want to get it further to away to protect myself. Of course, my call side is at a 3 delta. So I want to move this up to make up the 80-cent loss. Move this up to around a 9 delta. 75 to 95, or this is only 40 cents. 50, 80, so 11. I'm gonna go a little higher, collect at least 90 cents. Okay, so that takes care of gold. Now let me look at my S&P futures. I got 3 contracts on here. So let's see what happened here. What delta is that? I'm at a 9 delta, so I'm in good position. No need to do anything on the put side. And of course, on the call side, I'm at a 10 delta, so there's no need to do anything here right at this moment. So I'm gonna just let this. Right now, this is the position I'm most worried about because I have 3 contracts on, and this expires today. So this is the one that I'm going to keep more of an eye on. This one and the gold because those are futures, so there's a little different, than say those other positions because the other positions besides the S&P futures as well as the gold, those other positions expire on Friday or later, so I don't have to worry about those positions. It's just these 2 positions I got to concentrate on because these expire today. They have today's expiration, so I have to make certain that I'm safe for today. Okay, so right now there's no need for me to take any other action at this moment. I just went through all my positions and I moved a lot of them, into more safety for now because the markets look like when, it's reversing itself. And so I'm just taking evasive or defensive action to protect my capital, you know, because again, it's about playing good defense. You know, that is what stands out or what makes a person elite or a team elite is good defense. So, so I will talk to you guys later. If anything changes, I will let you know. Okay, okay, sorry. Okay, forgot to plug in my headset. Okay, it's 9:47 p.m. on Tuesday, February the 17th, 2026. The markets is now closed except for the futures market. I did a trade for the futures for tomorrow's expiration as well. Um, so far, you can see that I'm doing well overall with this year with the futures, and I'm also doing well overall. I'm doing well overall with the SPX. Okay, now yes, it says my profit is up. I mean, my P&L for the day is about $1,000. And that's nice and good. But again, the whole goal is to make you know good trades and stuff like that. And again, this is not financial advice. I'm not telling people to go out and do what I'm doing, but I'm just telling you what it is that I'm doing. Um, but if you go to trade in the markets, it's best to practice trade using a virtual account before using real dollars. Now, unfortunately, Tasty Trade does not have a virtual account, so you can't practice trade in Tasty Trade. You have to use real dollars. However, you could do what is called a back testing because they do have a back testing feature, but it's not actual trading. It's just telling you how your trade, a specific trade would have performed given a different, I mean, given a time period, whether you would have made money or lose money on a particular type of trading style. So that's all a back test does. But there are other programs or platforms that has excellent virtual trading tools like E-Trade, um, Thinkorswim, Moo. Those are a few that I know that have it. I think Fidelity may also have a virtual account. I'm not certain. Now, Thinkorswim is, which was once owned by the makers of Tasty Trade, made Thinkorswim originally. Then they sold it off to TD Ameritrade, and then TD Ameritrade basically sold it off to Charles Schwab. So Charles Schwab now runs and owns Thinkorswim. But anyway, that's neither here nor there. Um, I'm helping a student of mine, a friend of mine's, make money in these markets. She's trading um, to help pay her bills and stuff like that while she's looking for another job and stuff. She went back to school, things like that. So I'm helping her to trade so she could help pay her bills, and so I'm really grateful for her and for that. Um, so there's not much to say. I mean, I'm gonna post this video up on YouTube, and you're gonna see the adjustments that I made. It was quite a few adjustments, particularly on the /ES. I don't like making that many adjustments. You want to make no more than an adjustment or two. When you start making more than two adjustments, on one particular equity or on one particular symbol, it can get a little cumbersome and overbearing. So it's like, you know. Um, but that said, overall, I'm still happy the way things are going. Um, what I plan on doing is cutting down some of these positions. So what I'm going to do is start closing out some of these positions because having around 14 different positions on is a lot. Um, Even though I'm watching each position, it's easier to manage it when it's smaller. It's not as cumbersome like this. And I know people who have had on more positions than this, but for me, I'm more comfortable with a smaller amount than having 14 different positions on. It's better to focus rather than just simply, looking, for uh, every opportunity that's out there. Some opportunities are better than others. Um, some of these positions I do plan on getting out of, unless I already own the shares. If I own the shares, then I plan on, doing covered calls, which is basically a nice way of renting out my stock. So think of it as a rental income or renting a house out. You purchase a property and you rent it out. I'm doing pretty much the same thing with my stocks, except I'm doing what is called a rent to own, where I'm giving the person the right to buy the shares away from me. That's the only slight difference. But other than that, the concept is still the same. Um, but I just wanted to just keep an update on what I'm doing. I mean, I don't plan on posting every day that I trade. I think, that's a little overkill, but I do plan on keeping up often as to how my trading is going and stuff like that. So this way you can see, yes, on some trades I make money, on some trades I lose money. I mean, but the thing is this, you want to keep your losses small and manageable because not every trade is going to work in your favor. But if you have more trades working in your favor and your wins is exceeding your losses, you're ultimately going to make money because this is all about math and probabilities. I'm saying, as the seller of options, I have probabilities on my side, and that's a good thing. That's why I like selling options. But what you want to do is make certain that, you have some capital on the side. So in case you do have to make any adjustments, you have the capital to be able to do so if necessary. And also to avoid that dreaded, what they call margin call. Because if you get a margin call, what that means is that basically you don't have no more room for error because if the market drops, they're going to, first of all, they're going to require they're going to want you to put in more money, or the market has to rise by a certain points or percentage in order to get rid of that margin call. And if the market continues to fall or stays flat, and then you don't insert new money in, they're going to close out your trades whether you want them to or not. They're going to do that because the broker's going to protect their interest first because they're not in the business to lose money. So just know that. So to avoid margin call, you always want to have some capital to the side that you either can put into the market, or if you have it in the market, you want to have it to the side, so this way you could avoid that dreaded margin call. I mean, I've had it a couple of times. It's no big deal for me, but it's an annoyance more than anything. But for some people, like especially if you're new to this, I don't recommend the using of margin. If you're new, it's best to use cash if you're new, because it can get a little hairy if you get that margin call. I remember the first time when I got it, I kind of panicked a little, and you don't want to panic, And I told my broker, and at the time it was Options House. I missed them, by the way. I think they're part of E-Trade now, but it's not the same. But anyway, um, I told Options House, I'm not putting in any more new capital. because my trades were safe and they closed out my trade. I mean, it was still profitable, but it was still an annoyance that they closed it out, you know. But imagine if I was taking a loss on that position or a big loss. That's not what you want. So the best thing is keep your position size small, you know. Don't trade bigger than what you could, you know, comfortably manage. So that's the lesson. But tonight, um, yeah, I got out of my gold trade with a nice little profit. So you know, things was good today overall, despite the fact that the market was kind of what you would call flat in a sense. Anyway, I will talk to you guys later. Bye bye.